The dollar didn't just have a red day. It crashed to a 5-week low. And in the same breath, silver detonated past $58 like the resistance level wasn't even there. Most people will shrug and say, yeah, markets are volatile. But if you've been watching the pattern behind these moves, you know better. This is not random noise. This is the script we've seen before, picking up speed. This video is called Dollar Crashes to 5-Week Low, Silver Explodes, past $58 in epic breakout. And by the end, you'll understand 3 things. Why this particular dollar drop and silver breakout combo is a signal, not just a spike. Where it fits in the 4-stage pattern that has driven every major precious metal repricing in modern history. What to actually do and avoid doing while everyone else is chasing green candles or panicking into cash. This is not personal financial advice. This is pattern recognition. Let's start with what just happened. What you just watched on the chart. If you pull up a dollar index chart, today looks like a clean breakdown. A 5-week low on the dollar. Previous support sliced through in 1 or 2 ugly candles. On the silver chart, it's the opposite story. A grinding climb turns into a vertical push. That $55, $58 zone that acted as a ceiling, gone. Volume surges. Options flow spikes. Everyone suddenly remembers silver exists. To the average trader, this is just dollar down, metals up, correlation stuff, whatever. To someone who's studied the pattern, this looks like stage 3 tightening its grip. Let me show you why. The 4-stage script, condensed. We're going to compress the full framework into 1 minute. Stage 1, establishment. A commodity becomes money. It backs currencies. It sits in central bank vaults. It circulates as coins. Silver did this role for more than a century. Then governments stripped it out of money and told everyone, relax. It's just another industrial metal now. Stage 2, manipulation. Once it's just another metal, Wall Street builds a paper tower on top of it. Futures contracts, ETFs, certificates, unallocated pool accounts. For every real ounce, there are many, many paper claims. Paper is cheap to create. Physical is hard to mine. Prices stay tame. People call silver boring. They forget what it is. Stage 3, the squeeze. Demand for real metal quietly outruns supply. Industrial users need guaranteed ounces. Nervous investors want something that exists outside the banking system. Central banks and large players start wanting delivery, not just price exposure. Vaults thin. Deficits become normal instead of rare. Dealers quote higher premiums. You get days where spot trades above futures because people will pay more for metal now than promises later. That's the squeeze. Too many promises, not enough metal, slowly becoming obvious. Stage 4, the break. Eventually, something snaps. Trading halts. Deliverable contracts become cash settled only. New rules appear overnight. Higher margins, position limits, liquidation only orders. Paper holders discover they were holding tickets, not ounces. Physical holders discover they're just watching, not scrambling. That's the whole script. Now let's plug today's move into it. Why a weak dollar plus $58 silver is a stage 3 signal. Think about what the dollar represents. Every unbacked promise in the system rolled into one ticker. When the dollar slides hard while hard assets spike, the market is sending a very simple message. We trust promises less than we did yesterday. Silver exploding through $58 at the same time is not just a trade. It's a vote. Against endless money printing. Against long-term negative real yields. Against the idea that you can solve structural problems with more leverage. But the key isn't just price. It's context. We are not seeing this breakout in a vacuum. We're seeing it. After years of structural supply deficits in silver, after multiple episodes where big banks and refiners struggled to source physical in size, after a long period where premiums on coins and bars stubbornly refused to go back to pre-crisis levels, after more and more people started asking, do I own silver, or a promise that someone owes me silver? In stage 1 and stage 2, a move like today's would probably fade quickly. In stage 3, it often marks a transition. From, oh, this is interesting, to, oh, this might not be reversible without pain. That doesn't mean every green candle leads straight to $100. It does mean you should stop asking, is this noise? And start asking, where am I in this script? 2 ways people will react. 1, is a trap. Today's breakout will create two types of reactions. Reaction 1, the chaser. Silver's moving. I need max upside. This person loads up on leveraged ETFs, buys far out of the money call options, opens futures positions with margin because this time is different. They're not building resilience. They're buying a ticket to the most volatile seat in the stadium, in a market where the rules are known to change mid-game. If the breakout runs, they'll feel like geniuses. If we get a violent pullback or a rule change, they can get wiped out even if their big picture thesis is right. That's the Hunt's mistake all over again. Reaction 2, the builder. This person uses the breakout as information, not as an adrenaline hit. They say, okay, the dollar just signaled weakness. Silver just showed strength. This confirms the pattern I've been studying. Do I need to adjust my physical position or just hold and watch? They are not trying to time the top tick. They're trying to answer one question. If stage 4 happens sometime in the next few years, do I want to be standing there with tickets or with ounces? That's the mindset behind a physical first plan. Let's outline what that actually looks like in a breakout. A simple framework for a silver breakout without losing your mind. Again, not advice. This is a mental model. 1. Decide if you're early, late, or already set. Ask 3 honest questions. Do I already own any physical silver I can hold in my hand? If silver dropped 20-30% from here, would that position wreck me? Or would it just be uncomfortable? If silver went to $80 and $100 and physical became scarce, would I regret not having any ounces at all? If you're fully stacked and your allocation is sane today is mostly confirmation. You own nothing. But this pattern makes sense today, might be your wake-up call to at least learn how to buy and store an initial position. You're mentally all in but financially unprepared. Today is a good day to slow down, not speed up. 2. Use levels, not emotions. Big round numbers and breakout lines mess with people's heads. It's above $50. I missed it. It's at $60. This is the top. Instead, think like this. Below your fair value zone, you accumulate calmly over time. Around your zone, you maintain, maybe fine-tune. Far above your zone, you stop adding and let time work. Your zone will be different from mine. That's fine. What matters is that you're not making decisions purely off a single intraday candle. Today's breakout is a data point, not a command. 3. Keep your exposure and your ownership separate. It's okay to trade. You want a small, defined trading account to play breakouts? Fine. You want to own a mining stock because you like the company? Also fine. Just don't confuse that with sovereign wealth. Your trading bucket can live on exchanges, brokerages, and apps. Your no matter what bucket should live in places that don't turn off when someone pulls a plug. That bucket is coins and bars you can physically access, stored in a way where a margin call is impossible. Size so that even a nasty drawdown doesn't destroy your life. The epic breakout you just saw is exactly when you need that separation the most. Because breakouts are when people are most tempted to blow up both buckets at once.